Welcome, Namaste, Adab, Sat Shri Akal. Welcome to another webinar with Axis Mutual Fund. I am your host and your host, Aditya Tripathi, getting you an interesting webinar all again. Today, we have a very interesting person with us, Ms. Vandana Trivedi. Ms. Vandana Trivedi is head of institutional business as well as head of passive business and have been one of my mentors to understand the entire passive as a strategy as well as structure. Thank you for joining us today.
It's my pleasure, Aditya.
So the very first question that I have in mind, and it's been rolling out from a very long time, is momentum as a strategy. I have been hearing a lot thing about momentum investing and why you should look into pictures. So I would require your advice.
Sure. Okay. Momentum is exciting. It's one important reason why it's caught the attention of investors. Momentum as a strategy is also the largest AUM garnering strategy amongst the other strategies which we call as factors which are out there in the market. But before that, what is momentum? Momentum is built on the premise that any stock that has been recently going up will persist with the rising trend. So it's basically about catching the rise in the prices of stocks. To put it differently, in the momentum strategy, what we do is we buy high and we sell higher. So that's what the momentum strategy is all about. Two things. One, it looks at price movement of stocks in the portfolio, and two, it looks at prices which are on an upward trajectory, which are moving up, and the belief or the premise that they will persist to go up. So these are the two key themes that drive stock selection in momentum investing.
So I heard you about the stock selection and momentum. How can you define it much? Eventually, how does it look like? So what my understanding is that much of the momentum funds that I've been hearing about, they have a proportion of either mid cap or small cap stocks or large cap stocks. So what are exactly your views? That how does it?
Sure. Right. So like I told you, when there is momentum investing, in that fund, the objective is to only build a portfolio out of stocks which are exhibiting an upward momentum in their prices. Derivative is that you're really not chasing any capitalization like large cap, mid cap or small cap. You're really not chasing any sector allocation, that this sector looks good because of these government policies, or this sector looks good because of these underlying macroeconomic implications. No, we do not look at it. We're really not chasing any stocks because this stock has more liquidity, this stock has better governance. No, we're not getting stock specific as well. The only mantra that we are following is we are looking at, and it could be anything. We could look at the last 6 months price movement, the last 12 months price movement, the last 3 months price movement, adjust it for volatility, and then build it as a part of our portfolio, which keeps getting relooked twice a year. So that's broadly how a momentum strategy via an index fund works.
So for the fact, Axis is coming up with their new NFO, which is Axis Nifty 500 Momentum 50 Index Fund. Can you help us or give some ideas about the fund?
Yeah, so see, at Axis, the NFO of the Axis Nifty 500 Momentum 50 Fund is the objective of coming out with this NFO is to complete or to build the entire factor-based investment suite that we can offer to our investors. So we want to build that basket of factor funds which are offered via the passives route to our investors, and that's the reason why we are having this NFO underway. The NFO opens on the 24th of January and shuts on the 7th of February this year. So that's the reason why we are coming out with this fund. As the name suggests, this fund intends to track the performance of its benchmark index. The benchmark here being, like you said, the Axis Nifty 500 Momentum 50 Index Fund, and we will aim to track the performance of that index, subject of course to expense and tracking error, etc. So that's what we intend to do.
So a lot of the time I keep speaking to investors, and eventually investors come up with a question something like, what is difference? So usually people follow index like Nifty 200 momentum 30 index
True,
fund,
true.
whereas compared to what we are bringing is Nifty 500 momentum 50.
Yes.
So what are the actual differences between?
So see, yeah, you're right actually. Today, out of all the AUM in the momentum strategy in the market, almost 90% of it is tracking the Nifty 200 momentum 30 index fund. Some of it is also tracking as a momentum strategy, some of it is tracking subset of the larger mid-cap indices, etc. But the uniqueness or the benefit that the tracking the Nifty 500 momentum 50 index fund is that you get a fair representation of not only large and mid cap but also the small cap stocks. And as you would appreciate, any kind of a trend that is emerging, which is what momentum as a strategy aims to capture, is visibly seen or seen to a much greater extent in the smaller cap and the mid cap space, and therefore the Nifty 500 index actually offers you a larger universe to pick up momentum stocks from, whereas a Nifty 200, which was your specific question, leaves out the small cap category entirely. So to that extent, a Nifty 500 underlying fund gives you a far better shot at getting momentum in your portfolio than some of the narrower indices do.
So there are a lot of index funds in the market, something like Nifty 50 index fund or like Nifty Next 50 or Nifty Mid Cap 50. So there are a lot of, so how it differs from the index funds that we have?
Yeah, sure. So Aditya, see, like you're saying, there are a lot of index funds in the market. Most of the index funds which are seeing a lot of AUM as well are what we call as broad market index funds, right? So you have the Nifty 100 index fund. In fact, Axis has one of the largest Nifty 100 index funds in the market out there. You have the Nifty 500 index fund, obviously the more familiar Nifty 50 index and the Sensex 30 index, etc., right? So those are broad market themes. So that's one category of funds, and that's a large category in the Indian context. Then you have themes which we are talking about today. Momentum is a factor. You have low volatility, you have value, you have quality, you have mid cap based funds, you have small cap based funds. So there are these different themes that complement investments in a broad market theme. So what does a broad market theme do? A broad market theme gives you an overall exposure to corporate India, which you believe will replicate the nominal GDP growth of the country, right? If you believe in the India growth story, which all of us do, and if you believe that we will continue to be the fastest growing economy, which is what we are expected to, be at the position that we are expected to be at, given the recent IMF rankings, etc., then how do you participate in that growth? One very important way to participate in that growth is to buy into the corporates that are contributing to this growth, which is what the broader market indices are essentially doing, like the Nifty 50, Nifty 100, etc. Whereas these indices, like the factor based indices, what they do is they help you participate in those factors which are contributing to returns in various market cycles, right? So there will be one single factor that will contribute to returns a lot more than some others will, and therefore having a portfolio of stocks which actually plays that factor or plays that theme will stand you in good stead if that factor were to play out. So that's the relevance of some of these factors. To give you an analogy, broad market funds could be your dal roti, and then some of these factors could be the side accompaniments like the various sabzis that you may have in a plate, which completes the entire meal, but needs to be looked at as a satellite part of the portfolio maybe.
So a lot of investors that I meet on a day-to-day basis, much of the investors that I keep talking about, they have actually like 100% equity in their portfolio. So usually now people have started investing in index funds, and how would you suggest, like, how much of index fund or portfolio or percentage of portfolio should have?
Sure. So when you say 100% equity, you mean like direct stocks,
yes,
etc.?
Direct stocks, yeah.
Okay, so I was just speaking to someone else today, and they asked me the same question. So I'll give a slightly long-winded answer to this, Aditya. So what does the returns that you make from investments count for, right? You're an individual, you have some investments and you earn returns from it, right? What does it count for? It counts for what I call as a parallel income,
Correct.
right? There is a mainstay income that we all earn. It could be coming from salary, it could be coming from some business that I own, etc. And you make some investments and you earn some income out of it, which is your parallel income. In other words, you can call it passive income, right? Passive, distinct from the concept of passive investing. Now, if this parallel income is important, and it is important because your salary will have a finite life, your business might have a finite lifespan, but your passive or your parallel income could just go on forever, which is your income from investments, right? It only concludes that you actually give it the kind of time, the resources, the importance that it deserves, right? Because it's an important part of your financial health. Now, if you think that you're giving your investments, your direct equity portfolio in your example, as much time as you're giving to your work, right? You could be a practicing doctor or a lawyer, you could be earning a salary somewhere, you could be running a business somewhere. Are you giving your investment portfolio as much time as you're giving to what you pursue for earning a mainstream income? If your answer is yes, just keep at it. Don't do any change. But if your answer is no, then clearly you'd rather look at a more a more structured vehicle which will offer you exposure to equity as an asset class, and when you invest into that vehicle, you really do not have to look at your portfolio on a daily basis. So mutual fund is a great platform for that, and within that, index funds or index and ETF combination, which comes under the passive funds umbrella, is an even better option, because there is complete transparency of portfolio on a daily basis. You know that it's the market, right? So to that extent, you need not worry about committing time, energy and research into that important element of your life which will give you a parallel income. So that's how I'd like to put it.
So I was going through the NFO's detail, and there was somewhere I had read about the portfolio rebalance. Can you help us out a little more about it?
Yeah, so see, the general perception about index funds is that it's passive investment, which is that there is no element of active management in that. However, that's quite far from the truth. The active management of what goes into the index is done by index providers. It may not be done by fund managers, because the fund managers only replicate the index, but index providers look at the index, marry it to the underlying rule with which the index has been formed in the first place, and then keep checking if the current stocks within that index is actually matching up or mapping to the rules that have been framed for this particular index. If it is, then it just remains as it is. If it isn't, then you actually move out some stocks, bring in certain new stocks which would comply to those rules, and then you present an index which is true to the rules that you have set at the start. That's what we call technically as rebalancing. Different indices have different frequency of rebalancing. For our NFO, which is the Momentum Index Fund, Axis Momentum Index Fund, we have we rebalance the index twice a year. We, as in the index provider, which is NSE in this case, rebalances the index twice a year, which is where they check for the rules and see if each and every stock is actually meeting those rules, and and move out the stocks that don't and bring in the stocks that do. To give you a real life example, the recent rebalancing happened in December 2024, okay. Right? So the stock, as the name of the fund suggests, this is a 50 stock portfolio. When the recent rebalancing happened, more than 35 stocks moved out. And we actually, in that 50 stock portfolio, now have a new set of stocks relative to what we had 6 months back. So that's how important rebalancing as a process is, and the index provider does it.
So eventually it could be part of the large cap stocks or mid cap stocks or small cap stocks, depending upon the performance.
Absolutely right. Depending upon the price performance in the context of the momentum index.
So a very relevant question as compared to my life. So I have been planning to get married. I have some future plans along.
Excited,
yeah. And so I wanted to see if this investing in this NFO would be good for my future investments, and how could it be. So my ideal question would be, what is an ideal customer, and can exactly a person like me or people of my age group can actually invest in this NFO, and would that benefit us to create wealth?
Okay. So you have kind of opened up the door for me to get a little casual in this conversation. I'll answer your question, but first things first, if the question is if Axis Nifty 500 Momentum 50 Fund will help you get married, no. You have to do more than that, okay, than just investing in the NFO. However, yeah, I get the sense of your question. There are two questions here. Who is this fund for, and is it good for someone like me at my life stage, which is basically young with very bright professional prospects and looking to take on more responsibilities in terms of making a family, etc. Which I would mean will presume to indicate a person who is an early investor, right, and who has a long ramp towards achieving his financial goals. Then this fund is a great fund to invest in. The typical misconception about momentum as a strategy is that it's for the short term, because it's trying to catch a rising trend, and trends don't last long, and therefore it's a short term investment proposition. But historical backtesting data of the index suggests that over longer periods of time, this has actually beat broader market indices. This has actually beat narrower indices which are also tracking momentum as a strategy, etc. So to meet long-term investment goals, this is a wonderful investment proposition, because what it will do is, while your active fund manager in the active part of your portfolio is actually studying sectors, studying companies, meeting management, etc., and building a very high quality and high propensity to perform kind of a portfolio, this portfolio will ensure that you are always participating in every single trend that's out there in the market. So it will help you. It will also help investors who are more seasoned investors, say people like me who are not seasoned, not because I'm an expert or anything, but only because I'm at a certain life stage where I may have met many of my goals, financial goals, and there could be some more, but I may not have a ramp as long as you do, right? And at the same time, I have built a reasonable portfolio of equity investments. Now, to add the specific momentum factor to add to returns in my portfolio, this is a great fund. So therefore suits seasoned investors as well. Say you are a beginner, right, who's just kind of nibbling into equity as an asset class and trying to build a portfolio, etc. A small chunk of money could actually come into this fund, because what does this fund aim to do? This fund aims to catch every uptrend that is there in the market. So therefore it does deserve a place in your portfolio, as long as you're measured in your exposures.
So when you were talking about seasoned investors and new investors, much of the new investors that come to me and they ask me about questions like, will it be better to invest in an SIP or a lump sum in a passive fund? Probably in an index, because most of the time we have been informing them to invest in either SIP or lump sum. Both have benefits in their own way eventually, but then we market equity funds as compared to looking at the picture. So now, can you help me out in this question for the new investors?
Yes,
that's where.
Yeah, both for new and seasoned investors, really. SIP is a time-tested investment philosophy, right? While the market thinks SIP is an asset class, it's a huge investment philosophy which has stood the test of time, which has stood the test of market cycles. Forget market cycles; it has actually stood the test of huge drawdowns in the market, which are very episodic. What I mean is that it has stood the test of financial crisis, the COVID crisis, the dot-com bubble, all of it, right? So it is wrong to assume that passive funds may not need an SIP. What does this particular fund do, and what do passive funds do? Essentially, we're investing in the same market, right? We are just following a rules-based approach to investing in equity stocks, and therefore, why should an SIP not work? An SIP will certainly work, may certainly work better if markets, if markets continue to be volatile, which is what markets are. They're volatile all the time, right? And therefore, an SIP return will outperform a lump sum kind of an investment for longer periods of time. Therefore, the merit of doing an SIP, but more importantly, for new investors who may not have built adequate capital over their lifespan because they've just started on their professional pursuits, etc. SIP is a great way to keep, stacking up some money on a periodic basis. So definitely, yes, go for SIPs in the fund.
So, if you can just give me a more brief about the market outlook and how performance of momentum would be in particular order.
Okay.
According to current market outlook.
Yeah, sure. So the market outlook I'll take you through, and you would appreciate that market outlook changes not just from one year to the other, but many times within the year as well, right? What momentum as a strategy does is that irrespective of the market outlook, we just look for stocks which are on a current price upsurge, and we build a portfolio out of those stocks, right? In the case of the Axis Momentum Index Fund, what we intend to do is track the Nifty 500 Momentum 50 Index, where the performance that's looked at is the past 6 and 12 months performance adjusted for volatility, and there is a certain weight that's given to free float market capitalization, and it forms a part of the index, and those are the exact same stocks that we'll own in the fund, right? So at any given point in time, the momentum index will try and capture trends, to put it simply, right? So it's an all-weather kind of a fund, irrespective of what the underlying market outlook could be. However, one of the key risks to momentum as a strategy, and therefore not recommended for short-term investment horizon, is that over shorter periods of time, the drawdowns could be large, which means that you could actually see volatility in your NAVs, right? And therefore, over shorter periods of time, it's not recommended that you, not only momentum, but it's recommended that you do not invest in any concentrated strategy portfolios, be it momentum or a mid-cap fund or a small cap fund or any theme-based fund or a sector-based fund. So that applies uniformly to everything. Now, what is the market outlook? The equity outlook really for this year, as we see markets today, is that we are actually coming off a very healthy run-up in markets over at least the past 2 years. This would be a year where we would kind of sit back as a market, take stock, and look at the higher valuations that are seeing in the market, and see if corporate earnings growth indeed support these kind of valuations, which essentially means that you could go through a phase of markets just remaining flat or giving you negative surprises as well, until earnings growth kicks in reasonably, which we anticipate to happen sometime in the second half of the year. So the first half of the year could be a little staid as far as the last 2 years experience, relative to the last 2 years experience. The second half of the year could actually see an improvement in corporate earnings growth, etc., and therefore there would be a positive sentiment that would come into the markets, and the momentum would improve, etc. However, some of the key things which were weighing down the markets in the last year may actually settle down this year. One was that Indian markets are overvalued. So with the kind of correction, that recent correction that we have seen, you possibly getting in at valuations which are better than what you've seen for the better part of the last year. So from that standpoint, getting an NFO at this point probably augurs for a better entry than had this been brought in sometime last year. So that's one. The second thing is that almost an entire last year we were bogged down by a number of geopolitical tensions which had ramifications for domestic economy and therefore domestic corporates as well. Now if whatever Trump were to commit to the world were to be true, and we are seeing initial indications of ceasefire getting signed between Israel, Hamas, etc., then possibly you will see a year where geopolitical tensions kind of pare down. So that's a good positive for us to look forward to. So essentially, we're just about 20 odd days into the year, or the entire year is yet to unfold. a lot more needs to be analyzed to actually give a complete outlook, but the exuberance of the last 2 years may not be there in this year. The second half of the year may actually pick up for more steady state returns from the equity markets. Stock selection may become a lot more important this year. But irrespective of what the underlying theme is, there is a portfolio which is looking to stocks that are doing well in terms of their price movement, and the Axis Nifty 500 Momentum 50 is that fund. So an investment into this kind of a fund should stand you in good stead, provided you obviously have a longer investment horizon.
Well, thank you for the explanation eventually. So let's take few questions from the audience,
okay,
as we are live on YouTube. So one of the question that I can see is, are there any specific sectors or industry that the fund is currently favoring? And this question is by Himanshu.
Okay. So clearly, like I've been saying, the fund is favoring only price movement, right? So we are not chasing, or the index provider is not trying to build a portfolio which is overweight or underweight any sector. The index provider is only looking to build a portfolio which is defined as per rules that have already been documented and put forth on their website, and therefore looking only at price movement. The result could be that the fund looks overweight a few sectors, or the fund looks to be the portfolio seems to be under owning a few sectors, but that doesn't really indicate any sector bias at all. So no sector bias.
How does the fund fit into a diversified investment portfolio?
So we spoke about that. So a diversified investment portfolio gives you participation in the broad market, right? Whereas this strategy lets you build a small portion of your portfolio towards ownership in those stocks which are doing well in terms of their price movement. So to explain this a little further, since the question has again come up, so what happens in an active portfolio? In an active portfolio, the fund manager is looking for stocks which in his or her opinion will do well because the business is sound, it has significant moats, the management quality is top notch, and therefore you want to own that business, right? And you just buy that business, so to speak. You buy the stock and you sit with that stock for a medium to long period of time. There could be complete 6-month or 12-month periods where the stock does nothing, but I just buy that stock because it's a high conviction, sound business kind of a stock. Whereas in momentum as a strategy, what we do is that we look at a stock, we see that it's been doing well over the last 6 months and the last 12 months, the volatility is lesser, and therefore we build it as part of our 50 stock portfolio. And we tell you as an investor that here goes, this is a portfolio where price action has been great over the last 6 months and 12 months. So we think that it will continue to be good. The persistence of this price action will be there, and therefore you should invest in this fund purely from a price action perspective. So adding a momentum to your diversified portfolio actually gives you that thrust of price performance to the portfolio. So you keep getting gratified with hopefully positive price movement over longer periods of time. Of course, like I mentioned earlier, over shorter periods of time it could get volatile, there could be drawdowns, but that's true of any equity investment.
So far. So thank you for this amazing session. Eventually there were a lot of insights that have been working around. I made my own notes, and so does I think my investors as well.
I hope so too. Yeah, I'm glad.
So for all the investors that are watching us live, thank you for tuning in. We will be coming up with another amazing webinar. Till then, join us on Axis Mutual Fund YouTube channel and all the social media platforms that you have probably with. For investing in this NFO, you need to log on www.axismf.com, or you can also download our app from the Play Store or Android Play portal, and you can invest through it. Till then, keep investing. Take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.